So you want to own a vending machine empire. Buy a machine, park it in a busy break room, watch the coins and card taps roll in while you sleep. That's the pitch every side hustle video on the internet sells you, and it's not entirely a lie. Here's the number that makes it look real. The global vending machine market was valued at over $72 billion in 2024. And inside the United States alone, operators pulled in roughly $7.7 billion in revenue in 2025. That's a real enormous industry, and getting a single machine into a single location genuinely can throw off passive income. But here's the sentence that separates the people who build an actual vending empire from the people who own three machines and call it a side hustle forever. This business was never about the machines. It was always about the route, and almost nobody selling you the dream explains what that word actually means. Start with what a single machine can realistically do, because the internet's version of this number is wildly inflated. A decently placed snack and drink machine typically generates somewhere between $150 and $400 a month in gross revenue. After product costs, location commission, fuel, and maintenance, net profit usually lands in the 25 to 35% range, which works out to somewhere between $40 and $120 a month in actual take-home pay per machine. Put a machine in an exceptional location, a large factory floor, or a busy hospital break room, and you might clear $1,000 or more a month from that single unit. But here's the number that quietly runs the entire industry. Location alone determines somewhere between 70 and 80% of a machine's total revenue. The machine itself, the snacks inside it, the pricing strategy, all of that matters far less than the simple question of how many people walk past it every single day. This is where the fantasy usually collapses, because most beginners think the hard part is buying the machine. It isn't. A basic vending machine costs somewhere between $1,500 and $10,000 depending on features, and that part is easy. The actual business is servicing dozens of these machines scattered across a city without burning your entire margin on gasoline. Industry data shows that fuel costs alone can eat up to 40% of revenue on a poorly planned route, and the efficiency benchmark operators aim for is at least 10 stops per route hour. Every wasted mile between machines is money leaking directly out of your profit margin, which means the real skill in this business isn't sales. It's logistics. You're not really running a vending company. You're running a tiny, hyper-local delivery network, and the density of your route, how close your machines sit to each other, matters more than almost anything else you can control. Here's the mechanism that changed the profit math for this entire industry almost overnight, and it happened quietly, machine by machine, over the last several years. Cashless payment adoption hit 71% of all vending transactions by 2025, and operators who added card readers to their machines reported revenue increases of 30 to 40% per unit, because the average cashless transaction runs $2.24 compared to just $1.78 in cash. People spend more freely when they're not physically watching coins leave their hand. Retrofitting an existing machine with cashless technology costs somewhere between $300 and $800, and for most operators, that upgrade pays for itself within a matter of months. The machines didn't get smarter. The payment method did, and it turned out that was worth almost as much as adding an entirely new machine to the route. Now here's how this becomes an actual empire instead of a side hustle, because the answer isn't building more machines from scratch. It's buying other people's routes. When operators sell, established routes typically trade for somewhere between 0.3 and 0.8 times their annual revenue. And buyers usually calculate value using something called seller's discretionary earnings, roughly 15 to 25% of gross sales. A route generating $300,000 a year in revenue might sell for anywhere from $90,000 to $240,000, and the entire modern vending industry runs on this exact transaction happening over and over, one small operator at a time. This is precisely how the biggest player in the industry got that way. Canteen started in Chicago in 1929. Originally just a scrappy vending operator competing against machines so unreliable that peanut dispensers regularly jammed and candy machines simply didn't work. In 1994, Compass Group, a UK-based catering conglomerate, acquired Canteen in a deal that boosted their entire company's revenue by 114% overnight, absorbing a company that was already the third largest vending and food service operator in America, generating $1 billion a year with 25,000 employees. Compass didn't build that scale by installing machines one at a time. It bought an empire that had already been built that way by someone else and then kept buying. Canteen's largest franchise today, a company called Five Star Food Service, has grown to over 30,000 vending machines and 2,300 micro markets almost entirely through the same playbook, acquiring smaller regional operators, one route, one franchise, one family business at a time. So here's the final balance sheet, collapsed into one sentence. A single vending machine can genuinely pay you $40 to $1,000 a month depending entirely on where you put it. But the real fortune in this industry was never built machine by machine. It was built by operators who understood that a route is a logistics network worth optimizing, that cashless payment technology was worth more than any new location, and that the fastest way to scale wasn't installing more machines yourself. It was buying up the routes of people who'd already done the hard part and simply never scaled past it. The machines were never really the business. The density of the route around them always was.